Hello and welcome to the Tax Roundup for October 2014. And haven't the politicians been busy? As at the 5th of September, the mining tax repeal is now law. And as you know, it's not just the mining tax, but also the series of concessions that came with it. Let's have a look at the key issues. For business, the loss carryback rules have been abolished. Companies are only able to apply the loss carryback rules for the 2013 income year. The 6,500 instant asset write-off has been reduced back to its original 1,000 threshold. Any claims using the more generous write-off amount in 2014 tax returns for assets purchased or installed ready for use from 1 January 2014 will need to be amended. The 5,000 immediate deduction for motor vehicles acquired by small business entities has been removed from 1 January 2014. For individual taxpayers, the superannuation guarantee rate has been rephased again. Now SG will remain at the current 9.5% level until 1 July 2021. The repeal date of the school kids bonus has moved to 31 December 2016 and a means test applied until the repeal date. The repeal date of the low-income superannuation contribution has been delayed until the 2017-2018 financial year onwards, and the repeal date for the income support bonus has shifted to 31 December 2016. Also this month, Parliament passed the changes to the thin capitalisation rules. Now, the changes will have the greatest impact on large entities while releasing some smaller entities from the thin cap net. The changes tighten the safe harbour limits to 1.5 to 1 on a debt equity basis, reduce the worldwide gearing ratio for outbound investors to 100%, increase the de minimis threshold to 2 million of debt deductions, up from 250,000. But don't miss Knowledge Shop's cross-border workshop this month. It will cover not only the thin cap changes, but also the myriad of other changes and the focus of the ATO for clients with cross-border needs. Now, many of you would have seen the ATO turn their attention to professional services firms, in particular those carried on through a trust, partnership or company. Mike Carruthers explores the new guidelines.
Now, probably the big news this month for practitioners as well as our professional services clients is the ATO's guide around Part 4A and how you allocate profits of a professional practice. Now, this is an area that probably hasn't been well understood because the ATO hasn't had really specific guidance on this as far as I can see, and in the past the ATO's focus has really been on what do you do when income is from personal services. Now, this guide takes things a step further and looks at what the ATO's expectations are when you have a professional firm earning income from a business structure, so it's not personal services income. And I think many people have thought that once you can get into that category where you've got income from a business structure, then you've pretty much got free rein to do what you want with those profits. The ATO is saying that that's not necessarily the case. The ATO does have some concerns that those practice profits are being shared amongst not just the principal practitioner, but related entities, their family members, for example, in a way that means that the practitioner isn't being adequately compensated for the value that they've contributed to the firm in the first place. Now, from a practical point of view, the ATO guide actually sets out 3 safe harbour guidelines. And what the ATO says is that if you can pass any of those 3 guidelines, then you'll be low risk when it comes to Part 4A. Guideline 1 looks at whether the principal practitioner has received income, and this could be salary and wages, or it could be a distribution of profits, doesn't really matter how it gets to you, but income that is at least as much as the highest salary paid to other professionals within the firm, so professional employees other than the principals. So where you do have employees within the firm who are providing services that are similar to what the principal practitioners provide, then you can use the top salary level as a guide. As long as the principal practitioners are being paid or receiving income that's at least as much as that top salary range, then the safe harbour is passed and you'll be assessed as low risk. Now, if there aren't equivalent employees within the firm that you can compare with, then the ATO suggests that you could use salary levels at other comparable firms. Now, that might be using salary surveys that are published. The second safe harbour looks at the percentage of profits that end up in the hands of the principal practitioner. So if we assume we had a principal practitioner who was working in the firm, but let's say their interest in the firm was held through a family trust. and the family trust distributed some income to that person, but also to a spouse, an adult child, and a bucket company, for example. The ATO says group together all of that income, a gross income, and look at whether the principal practitioner, has received or is entitled to 50% or more of that income. If the answer to that is yes, then again, that principal practitioner will be assessed as low risk under Part 4A. The third safe harbour looks at the effective tax rate. So again, the effective tax rate of the principal practitioner and all of their associated entities. And the test is really, is the effective tax rate on the income earned through the practice in the hands of all those entities, is it at least 30%? If the answer is yes, then again, assessed at low risk under Part 4A. The ATO says if you fail all three of those guidelines, then you'll be put into a high risk category. Now that doesn't necessarily mean you've got a problem, but it means that you are subject to probably a much higher chance of ATO audit activity or review activity, and you might have some pretty tricky questions to answer as well. Now, when you get into that category where you've failed all three of the guidelines, the ATO says they will then apply a second measure. And the second measure is basically what's the effective tax rate on the income that is flown out of the professional services firm. The lower the effective tax rate, the higher you go up on the risk scale. So some pretty practical guidance from the ATO. Whether you agree or disagree with their approach, at least now you know where you stand, and your clients should now know where they stand. So it can at least make an informed decision in terms of profit allocations, and particularly there'll be many clients, I imagine, who will want to stay under the ATO radar. They'll want that low risk rating. At least now we know what we need to do to get them that risk rating. So be aware of that guidance. The ATO says they will review it and update it from time to time, but certainly it's made the picture a little bit clearer, albeit for some clients they may not be real happy with the final result.
Don't forget, if you haven't contacted Audit Shielders yet, and I know you've probably been meaning to do it, then give them a call and make sure that you protect your clients from the cost of regulatory and government audits.
In relation to Bentivolio, this case at the AAT went through some of the Commissioner's views in relation to non-commercial losses and what the tribunal held. So in this particular situation, Mr. Bentivolio had non-commercial losses going over a period of 5 years in relation to his olive growing business. He had applied for private ruling and the Commissioner said no, discretion will not be exercised. For some taxpayers, that's the end of the story. However, in this particular case, the taxpayer said no, I think I've got a really good case. So he went to the tribunal and said, here's all the facts and circumstances and the extenuating circumstances I would have liked the Commissioner to consider and exercise his discretion so that I can use my non-commercial losses against my other income. So the tribunal did go through all the facts and circumstances and said, yes, actually there are some very extenuating circumstances here. Out of the 5 years in question, the taxpayer had fire, he had drought, he had a severe infestation bug on his olive trees, which obviously had a huge impact on how much volume could be produced, and also his wife was quite ill. Now, not only was she his wife, and obviously he was concerned about her, but she was also a key part of the business, because she was a very experienced olive grower and blender herself, and she had medical issues and recuperation time that stretched over several years. So the tribunal felt, looking at all the facts and circumstances for each of the years in question, that 4 out of the 5 years the Commissioner should have exercised his discretion and allowed the taxpayer to use those losses against the rest of his income. Now, for the 5th year, the tribunal held most of those extenuating circumstances which started in earlier years should have been dealt with and should not have had a negative impact as much in the 5th year, and therefore for that year the Commissioner should not apply the discretion. But notwithstanding that, 4 out of 5 years was a pretty good result for the taxpayer.
Finally, Ray explores a case dealing with the tax treatment of compensation.
The Riley case was also recently decided at the AAT. Now, the situation here is that Mr. Riley was injured in a work-related event in 1997. He went whitewater rafting as a team building exercise and got injured. Point to note, separately, you might want to consider your team building exercises. In relation to that, Mrs. Riley basically left full-time employment so that she could care for her husband. She did still continue to work, but it was mostly part-time or temporary basis, so she was there as the primary caregiver for her husband who had been injured in that accident. In 2012, the employer's insurer said, we will be happy to pay out a certain amount in relation to domestic assistance per week. The taxpayer's husband put in an application under the workers' compensation legislation to have a lump sum payment made in relation to compensation for his spouse, the taxpayer, in relation to the cares she provided to him as the injured party. She received that payment in November 2012 as a lump sum payment under workers' compensation legislation. She tried to take the position that that was a capital amount because it related to such a long period of time, of over 12 years, even though it was made one lump sum payment several years later. Unfortunately, the AET did not agree with that particular view. They looked not only at the workers' compensation legislation, but at the nature of the payment she received. It was a compensation payment for her for all those years she had cared for her husband. It was specifically stated as compensation for providing services to the injured party. And the amount that was paid out was calculated in terms of an hourly rate. So a key factor is, if it has the nature of compensation, then it should be treated as compensation. Ordinary, assessable income. Unfortunately, not the capital gain that the taxpayer wanted.
And that's the tax roundup for this month. Don't forget, if you're not a member of Knowledge Shoppers yet and you want to see what you're missing out on, then give Julie a call on 1800 800 232. We'll see you next month.